Good afternoon, ladies and gentlemen. Welcome to this special episode of Market Gurus, where you get to meet the finest brains on the last street that make money over the longer term for their investors. We'll take a small detour today. Normally, you see a lot of equity strategists, equity fund managers, and brokers coming on Market Gurus. But today is a special day. We welcome Mr. Sandeep Yadav. He is the head for fixed income investment at DSP Mutual Fund, a very fine gentleman who deals with bonds of various durations. So this is something new for me as well. So my questions are going to be little easy. We are trying to understand how India's bond market works, given the correlation that it has with the US bond markets, and of course a lot of macro data. Welcome, Sandeep. Just a little background note on you so that our viewers understand where you are coming from. Sandeep is responsible for 50,000 crore rupees within DSP Mutual Fund. He manages a lot of debt instruments which are spread over 15 schemes. He's been the head of fixed income investment at DSP Mutual Fund for the last 3 odd years, and before that Sandeep was with fixed income treasury trading for 16 years. A very warm welcome to you, Sandeep. Let's start with the very basics. When do you see the Reserve Bank of India cutting interest rates and making lives easier for all those people who have home EMIs, those who want to buy cars, and those who want to buy good assets? Sandeep, you are on mute. You will have to unmute yourself.
I'm not in mute.
We can hear you now. Please continue.
Yeah, so I wish I knew the answer to your question, but there's been a lot of uncertainty in the markets right now. It's very difficult to predict when would RBI cut. While we are all mostly in the consensus that the next action of RBI will be a rate cut, that is a certainty, near certainty. But I would believe that RBI's actions of rate cutting would be as much aligned to domestic factors as they will to what US Fed when they cut the rates. So, and according to us, it will be most probably in the last quarter of this financial year is where we are pegging that probably US would also cut, and RBI would also probably take a lead from US and cut.
Okay. Sandeep, there was this broad thought in the market that the US Federal Reserve would cut interest rates in the first quarter or the first half of calendar 2024. That doesn't seem to be materializing, and given the strength that's coming into the US inflationary data, it seems that even 2024 doesn't seem to bear good tidings as far as rate cuts are concerned in the US economy. If the US doesn't cut, neither do we. Where do you stand on this one?
Well, frankly speaking, we are neither on the left nor on the right. So when people were expecting rate cuts, I think the market went overboard and we're expecting 200 basis point rate cut in this calendar year. Now, when, as you rightly pointed out, inflationary data has come a little bit stronger in US, suddenly there's a large part of the market which is saying that there will be no rate cut. We stand in neither of the grounds. We stand close to what Fed is saying. Fed has always been consistently saying that they will do maybe around 2.5 to 3 rate cuts. Because of the stronger data, that comes down to probably 2 rate cuts in this calendar year. So yes, one thing is certain that the rate cuts will most probably not happen in the first half as most of us were expecting. But second half, those 2 rate cuts do seem on the line. And to say that US will probably not do rate cuts in this calendar year might be then going overboard on the other side of the fence.
Okay, so let's just analyze it a little bit more. You mentioned that you see rate cuts happening in the Indian economy towards the fag end of 2024. Would you guess the size of cut that would happen?
That's a very difficult question. There's so much of randomness in the markets and data right now. If you were to put a gun on my head, which I know you're not putting, but assuming you do put, I think I would go more with a 50 basis point rate cut by the end of this year.
Okay, so
at the end.
Okay, so the repo rate now stands at about 6.5%. You're looking at a 50 bips dip in that. Now comes the most interesting part, Sandeep. I wake up every morning at about 5:30 a.m. and the first thing I look at is the 10-year US yield currently at about 4.6, 4.65. And once I look at that number, either I take a deep breath or I say, oh my God, today is going to be a bad day. To it was also linked the Indian 10-year yield. Now, what are your views on both of them? Once they soften, Indian equities go up, and that's the reason why at least I live. Where do you stand? Do you like higher yields and therefore lower bond prices, or do you like lower yields and therefore higher bond prices?
Very good question. Firstly, let me tell you that's the way I start my morning as well. The first thing I do is look at the US 10-year yields. Well, we would certainly prefer lower yields,
Yes.
largely because we also, the position in our funds, we have taken a higher duration in our funds, and if the yields come lower, it makes much more money for our investors. So we prefer
Yes.
lower yields, but even if the yields don't fall immediately, we are quite okay with that because the coupon in the Indian bonds is also quite high. Unlike US, where you're going to get 4.60% in 1 year if you hold and the yields don't move. In India, you're going to get closer to 7.20%. So we
Yes.
don't mind if yields don't fall because the coupon is good. But yeah, I would prefer low yields.
Okay. And you also have a US Treasury product, if I'm not mistaken. So,
Yeah.
what's the size of that product, and where do you see the yield? I just want to understand December 31st, 2024, where is the US yield headed? And given that you are thinking of a 50 basis points cut in India, where is the 10-year Indian yield likely to be?
Absolutely. So I don't know the latest size, but I don't think it's significantly high because we cannot take any more new money because there's a RBI limit
Yes.
on investing in abroad ETF, and we cannot take any more money from our clients. So unfortunately, it's quite frozen for the time being until RBI increases the limits. But looking at the second part of the question, where do I see Indian bonds yields if there's a 50 base point rate cut? Well, to be very honest, in India, especially lately, it's not the inflation or the RBI's rate cut trajectory which is going to decide US Indian yields movement. Rather, India's yield movement is being driven by extraneous factors like demand and supply and the fiscal deficit, and of course the government borrowing, which has been much lower this year than last
Yes.
year. And I'm not even talking about the bond infusion, which will come later this year. So I believe Indian bond yields will react much before the rate cuts happen, not because they are reacting to the expected rate cuts, but just because the extra demand is going to really swamp the market. We expect around 680 levels to be reached maybe the somewhere in the second half of this year. I think that's, at least for me, it's right on the cards for that a 10 year should hit 680. Most probably lower than that, but we'll see how data pans out at that time to revise our estimates.
Okay, ladies and gentlemen, let me just simplify this for you. By 680, actually, Sandeep means that the 10-year yield will be at 6.8%. What's the drop in BPS that you're looking at between then and now?
Sorry, drop in. I couldn't hear.
Basis points. I mean, it's
Yeah.
7.18 now.
Yeah, it's around 7.20%. So you could say 40 basis point or 0.4% is where we see. Of course, no one is, we are not putting a hard target of 6.80. It could very well go to 6.70 also. Not much of
Okay.
a difference. So 40 to 50 basis point downward move is what we're expecting in the second half of this year.
Okay. Ladies and gentlemen, in the world of equities, we deal with the fluctuations of 20% as far as circuit limits are concerned, up and down. But, for people like and fund managers like Sandeep, a 10 basis point move either way makes an appreciable dent in their assets under management because bond prices move converts to what yields are, and therefore even a 10 basis point move is dramatic, and he is expecting a 40 basis point dip in yield, which essentially means that we are looking for a bond rally between then and now. So, with that background in mind, let's now take this discussion forward. Sandeep, it's often said that India's macro is one of the best in the world, and from a situation of being in the fragile five in 2014, we are now boasting of perhaps the best macro balance sheet globally. One, do you agree with this statement? And if you do, what are the 3 or 4 points you think that are very good as far as India's macro is concerned?
No, absolutely. I completely agree. In the last few years, we have seen a dramatic improvement in India's fiscal balance. So that would be the first part. So if we see, while India's fiscal deficit, that is the amount of money that the government of India spends extra by borrowing money. So India's fiscal deficit has increased, but the fact is, it is not the right way to look at it. If you look at how the Indian government-owned companies, which we call PSU companies, their borrowings have come sharply lower, and Government of India has really strengthened the fiscal numbers. And that shows somewhere when we look at Moody's and Fitch and the S&Ps, when they talk about India, they talk about India in a different lens right now, especially when it comes to the fiscal part. Now, this is quite stark to what is happening to the rest of the world. If you see in US, fiscal deficits is really
Yes.
becoming a worry. People are talking about government spending more than they are earning. And that's the same across the world, not just in US. And India is in a very different state over there. Historically, we've always had worries on fiscal deficit, not so right now. Of course, the second thing is India's FX reserves. They have also increased quite a lot. We are at an all-time high, more than $600 billion. If you remember, in 2013, India was in a very bad shape when it came to the FX reserves. The Governor Subbarao had to increase rates by 300 basis points overnight. So these are the two parts, where we see India really in a very strong macro situation, especially vis-a-vis other emerging markets.
Okay, I'll give you a wonderful statistics, ladies and gentlemen, and you'll understand fiscal deficit in a jiffy. The government of India earns on a regular basis, on a daily basis, 8,000 crore rupees. Now, those 8,000 crore rupees come from the taxes that you and I pay, the GST that the government collects, a lot of customs duty, and anything and everything that can come into the government kitty. So that's 8,000 crore rupees a day, but it spends 13,000 crore rupees a day feeding 80 crore people, funding the infrastructure that you have, keeping these lights ablaze. So between 13,000 crore rupees and 8,000 crore rupees, kharcha or amdani is the fiscal deficit on a daily basis. So that, ladies and gentlemen, is under control because we are spending this deficit, this extra money that we are borrowing, on creating assets which on a later date might pay very well. Okay, Sandeep, now let's shift to how exciting your life will be from June onwards. Ladies and gentlemen, the Indian sovereign bonds, the government securities that the Finance Ministry and the Reserve Bank of India issue in tandem will be included in the JP Morgan Global Bond Index. So, Mr. Yadav will be a true global bond manager because he will be now looking at the JP Morgan Index. Sandeep, two things. How does that change the Indian bond landscape, and how does that look to get money into India over the longer term? These days, we've been conditioned to being brought up on FDI money and FII money. This is going to be the beginning of global bond money coming into India. How will lives change for fund managers such as you and for the Indian macro balance sheet?
Sure. I think I'll just start by giving a primer on what historically has been the foreign inflows in Indian debt. India used to have decent foreign inflows before 2013, if I recollect right.
Yes.
But for the last 10 years, that those inflows have really petered down. India has had one of the lowest ownership of Indian bonds by foreigners. Last year, it was one of the lowest numbers. Now, in such a scenario where Indian bonds are generally were not liked so much by the foreigners, suddenly JP Morgan Bond Index means that around $25 billion of money will come in the next 10 months, which is a significant amount of number. So yes, it's very good. It's very good for bonds. Indian government is not going to issue that much of bonds because, as you very nicely pointed out, India's fiscal deficit is not so high. India will not issue so much bond. There will be a lot of demand. Now, the second part is firstly, this is very good for India. This year, we are going to see drop in yields, and we don't know how much, but it could be really sharp later on in the next, going into next year. But there's a second part to it, and the second part is when this JP Morgan bond index inclusion inflow ends after 1 year, then probably next year may not be that good, and that may be the end of the sugar rush. This is the way I look at it. So we might see a little bit of volatility, but this money is here to stay. The money that comes,
Yes.
$25 billion, is not a hot money. It's not going to go away. It's indexed money. It's a passive money. And unlike the previous monies that India has got in Indian debt, which went away the moment there was a risk, this money is not going to go away. This is here to stay.
So, will that improve? Of course, ups and downs are a part of life. You are towards the fixed income side, most of the people are towards the equity side. I am not doubting the fact that money may move in or out, but is the longer term trend, maybe 10-year secular monthly number going to be positive?
Absolutely, it's going to be positive. No two ways about that. I have got no doubt. And we just mentioned about JP Morgan, but there are two more indices, Bloomberg index and
Yes.
there's a 50 Russell index. They will also add sooner or later is my assumption. And in such a scenario, you will see consistent money coming into India.
Okay, so that's a positive for the Indian balance sheet, that global money, apart from being invested in factories, apart from being invested in equities such as HDFC Bank and Reliance Industries and Asian Paints and Infosys and what you may, it will also come into government security. So there's another funnel that's opening into India. Now, Sandeep, how will that change the rupee? The structure that we see at the moment is at about 83.35 versus the dollar. The rupee is not exactly in great shape. Do you see that do you see the pace of annual depreciation of the rupee, which is about 3.5% to 4% a year, sort of reducing?
Not really, because the pace of depreciation is also linked to the interest rate differential between India and US. And
Yeah.
while you're right, historically it's been closer to 3.5%, 4%, but for the past, at least for the last 1 year, we know it hardly depreciated by 1.5%, which is again linked to the interest rate differential, which is what the differential is right now. But it will certainly help ease RBI's life in the sense of volatility of rupee. But I think more from a structural point of view, it won't really make too much of a difference, because anyways the money is coming for 10 months, and then the money is not that big to impact India, because we are talking about 20 to 25 billion dollars even this year. Next year, $2.5 billion, not a big number when your trade deficit goes to $30 billion monthly.
Okay, fair point. Much of the rupees machinations are to do with the export-import data, and given the the tepid conditions of many of India's export markets, there is always pressure on the rupee. Let's look at the growth prospects of the Indian economy, Sandeep. Upgrades coming in from a clutch of global rating agencies, and a lot of people appreciating the excellent work that the government has done in terms of raising public infrastructure over the last 2 or 3 years. How do you see Indian GDP, say for FY25, and are there scopes for further improvement within the RBI as also in global rating agencies?
That is one number which becomes very difficult for me to guess, because we are not, because GDP is very difficult to guess, but maybe this year is a year when we are going to see a lot of volatility and inflection points in global GDP as well, and that will have some bearing on Indian markets. So I would really not want to hazard a guess over here, because things are volatile right now and there's a lot of uncertainty, especially when it comes to growth. We have seen some false alarms on global GDP falling, recessions happening, which haven't happened, and just becomes so difficult to guess. But yes, I must say that we are not seeing any risks of collapse of GDP growth rate right now. And we are quite comfortable, and we believe India is in a pink of scale. I would not put a number to it, but we just don't see any risk to the growth right now.
Let's just say anywhere between 6.5 and 7%.
I would say that, yeah.
Okay, let's
6.5, probably a little bit on a
yeah.
lower side, because as I said, global GDP, we don't know how global markets behave in this year.
I am yet to meet an aggressive Indian fund manager on the bond side. Let's take 6.5. Now, what do you think is the secular inflation number that RBI is penciling in to its calculations? I just want to see nominal GDP growth.
I believe RBI is talking about 4.5% is CPI. And when you go into nominal, you generally take a mix of CPI and WPI. So I would say around 4.5, 5 is, let's take it somewhere on that. That comes to 11%. And if I'm not mistaken, I believe 10.7 or 11 was the budgeted number also in the nominal growth by the government of India.
Yeah, it's 10.5. So, ladies and gentlemen, now we've arrived to a number which is actual GDP growth. Let's say the base case 6.5, and we are penciling in a 4.5% inflation number, which RBI is looking at in the longer term. So 6.5 plus 4.5 is 11%. 11%, ladies and gentlemen, is Indian nominal GDP. Add 2 or 3 percentage points that banks want to earn when they lend to you. So that's about 14.5%. Now equities, ladies and gentlemen, will appreciate in the longer term at this CAGR. That's the reason why this calculation is so important for equity strategists, and this is where our friends from the bond side help us. They give us the growth number for GDP expansion plus inflationary expectations. We add 3% from our side, and that's the CAGR that the Nifty should do in the real medium term. A couple of last questions to you, Sandeep. At the moment, how do you see liquidity as far as the daily bond markets are concerned? Are you adequately supplied?
Yeah, liquidity has in fact not been an issue because RBI is doing a lot of micromanaging when it comes to VRR and VRRR. So
Yes.
liquidity used to be a big issue 2 3 years back when it used to lead to a lot of volatility in overnight rates. But from the perspective of money markets investor, I think liquidity has ended up being a lesser of an event for us. And having said that, I believe there's nothing hugely worrisome in the liquidity front right now.
Okay, wonderful. Now the last two questions to you, Sandeep, and this is the 25-minute broad scenario that I and Sandeep have drawn for you. Comes the most important part. Rate cuts are in the pipeline. That essentially means that yields will go down, and therefore bond prices will appreciate. Now tell me, the two parts of the bond portfolio that a normal retail investor should have in his portfolio, which might help him make capital appreciation and give him the comfort of a fixed income return.
Absolutely. My personal favorite is dynamic bond fund category. So I won't tell specific fund names, but the category
Yes.
dynamic bond fund category is a very good category, especially right now to make capital appreciation gains. And on the other hand, if a person is more risk averse, then I would say go a little bit in a lower duration, and probably short-term fund is a fund which should not give you much volatility on either sides. So I like
Okay.
both fund category as well as dynamic bond fund category. I think these should be good part of your diversified portfolio.
If fixed income were to be about 10% of the overall portfolio of a particular person, how much in dynamic fund category and how much in the short term fund category?
I would prefer 7% in dynamic and 3% in short term, largely because I think 10% is too less of money to be put in fixed income.
Yes.
And if putting a little bit lesser, then you might want to take a little bit more, longer duration, which will give you more capital appreciation, which is dynamic
Okay.
bond. So probably more of dynamic bond and lesser of short term.
And just for the benefit of our viewers, why do you call it dynamic fund?
Because this is the only category where SEBI allows a fund manager to do to take any
Trade.
risk that you want to. A long duration, short duration, credit risk, non-credit risk, a fund manager can do what they want to. So they can get the maximum capital appreciation or yield for you.
Okay, let me just put it in very simple English. Sandeep has explained it well in his bond, how should I say, vocabulary. The dynamic fund category, ladies and gentlemen, is equal to the flexi cap category on the equity side. Am I right?
Absolutely, bang on.
Okay, Sandeep, it's been an equal pleasure listening to your views on how bonds move and what are the expectations on interest rate cuts, and of course the US 10-year and the Indian 10-year. I wake up every morning and see these two data and then decide what to talk about in equity markets. Thank you so much for your time, and I'm sure your life is as interesting as ours is on the equity side, and we hope you do phenomenally well when Indian G-Secs find their rightful place in the global JP Morgan index, and we also look forward to wonderful and very thick inflows coming into the bond part of our investing universe. Thank you so much for your time.
Thank you very much. Thank you for having me.
Okay, ladies and gentlemen, this was at least a very wonderful discussion for me. I got to learn a lot of things on how bonds work. I had a fair idea, but then it's always good to get it from an expert, and Sandeep Yadav was just the right man. He's the head of fixed income investment at DSP Mutual Fund, manages 50,000 crore rupees, and requests you to look at two debt categories, which is the dynamic fund category and the short term fund category. There are hopes that Indian interest rates will move lower. Sandeep says that about a 50 basis point cut is expected at the fag end of 2024. That will make lives easier for us, for those who pay EMIs and those for who are looking to lower interest costs to buy things that they desire. Thank you so much for your time. I hope you enjoyed this session as much as I did and our PCR team did. Thank you so much for being with us. Do stick on to Business Today for all your news on the financial side. Thank you so much.
Okay, before I head to my vacation, I do need to wrap up this shoot. Most importantly, I am running low on battery. When you're low on juice, all these smartphone companies, Apple and the Android guys, have now started offering you fast charging. What does it mean for your battery health, especially when you're selling your old device? What kind of impact does it have on